Stephen Meade again, back with another Bullseye Guide podcast. What are we going to talk about today? Crypto winter. I think this might be the third or fourth crypto winter. There's been some massive crashes, but back in the time initially it was Bitcoin, then it was Bitcoin and a few other things. The zeitgeist of crypto, obviously into 2022 here, has hit a mainstream vernacular where more people know about it, more people are trading in it, and more people still don't really understand what it is. So let's go back to my theory. What do I think crypto is? To begin, I think most cryptocurrencies, if we explain them, are glorified penny stocks. What does that mean? Does it mean it's a scam? Absolutely not. Is it a Ponzi scheme? No way. There's no promise or guaranteed return. New people coming in don't make you money. Bitcoin's not a lot of things that people claim it is, but here's what it's not. It's not a simple investment with a guaranteed return. It is a risky, speculative asset. Now, again, it has wild swings. If we look at gold, I've made this parable before. Gold, a brick of gold, $500,000. Not everybody can buy a brick of gold. You can buy a $10 piece of gold or a $50 gold coin. That gold coin goes up and down at the same percentage as a brick. Now, gold doesn't have wild swings. Bitcoin does, but Bitcoin's swings look dramatic. Now, crypto's really down 90%, but let's talk for a minute about simplicity. Percentage-wise, if Bitcoin goes from 40,000 to 30, that's a $10,000 drop. Sounds like a lot, and it is. But as a percentage, 40,000 to 30 is 10,000. That's 25%. Is that a lot? Yeah, it's still a lot. But 25% when you look at other stocks and other asset classes, that kind of swing isn't out of line. Why do I say crypto's more like a penny stock? Most penny stocks in the US are called OTC, over the counter, Toronto Stock Exchange, Australia, ASX. These penny stocks, what are they? They're highly risky, extremely volatile. Something could go from 10 cents to $1 just as easy as it could go 10 cents to a penny. That's a lot of what crypto can do. So we have these massive swings in the environment, and we've had some massive swings, some collapses. Terra Luna being one of the biggest. Massive collapse, really caused problems within the industry. But what else happened? Let's talk about it in relation to the crash of 2008 and 9, or what a bank does. And again, sometimes I like to explain this for simplicity. The guys deep in the crypto get this, but I still like explaining things. If we put $1,000 in a bank account, what do we get back from the bank? We get a debit card, right? We have an account balance, but that $1,000 goes in the bank. We get a $1,000 debit card. That debit card is digital money. What does that mean? If I put $1,000 in Tether, USDT, or Circle, USDC, I get a digital dollar, but it's still, quote, asset backed. Why is that important? What do banks do with our money? If we put in 1,000 or 10,000, how do banks make money? They loan those dollars out to try and get a bigger rate of return than just holding the cash. What happened in crypto? Crypto, in my opinion, part of my French, became a big circle jerk. It became companies taking Bitcoin as an asset and then lending that out or investing in other things, trying to get better rates of return as a percentage than what Bitcoin was doing. What happened to the collapse? Well, when you've got companies like Celsius, again, I've known Alex for years. I like Celsius. I like BlockFi. I thought crypto lending against an asset is a great business. What happened, unfortunately, behind the scenes? You put $10,000 in Bitcoin in a lending platform. You borrow money. That lending platform, rather than sitting on your collateral, holding the Bitcoin, ended up, in my opinion, reinvesting in other more risky asset classes. Those are more risky crypto assets, more risky projects. That's like taking money in a company like a bank and saying, hey, we're not going to be a little more safe with it. We're going to put it all over here in a bunch of penny stocks and pink sheets and gray listed companies and things you can't really validate because they're getting a high rate of return. And that high rate of return looks good as long as it's giving you a high rate of return. And so again, we're in a crypto winter. Things are down 90%. Will they recover? Is this good? Is this bad? Or is it indifferent, like who really cares? Again, in my opinion, we need to do a separation. We can't have the conflation of blockchain, which is an underlying technology, and crypto, which is a type of asset that does a bunch of different things, right? Even non-fungible tokens, NFTs, are blockchain components for a specific purpose or a different function. Why is that important? Let's think of the internet. I like to joke. No such thing as a blockchain company. It doesn't exist. All of you venture capitalists that are saying, oh, I'm a blockchain VC, you're not. What do I mean by that? If somebody says I'm a blockchain company, I say, what do you do? Oh, we do gaming. Then you're a game company. Oh, no, we're really blockchain. No, you're really a game company that uses blockchain as the technology. Again, the venture capitalists, I would ask them, excuse me, before blockchain, what kind of VC were you? What did you invest in? Oh, we like fintech, financial technologies. We like ed tech, education. We like marketplaces. Great. So if you're investing in marketplace technology and I bring you a game company, are you interested? Oh, no, we don't do gaming. So some game company on blockchain is irrelevant because you're not a blockchain investor. Let's understand the distinctions. Blockchain is the enabler for the industries and sectors that sit on top of it. Again, why is that important? Cryptocurrency in and of itself, if we conflate the things together, is sort of like a penny stock on internet companies in the dot-com days, right? If we fast forward, if I say, give me an internet company, there's people look at me, Google. No, Google's a search engine. Facebook's a social platform. Netflix, video distribution. You guys get my point? The internet empowers the companies that sit on top of it in the industries and sectors that utilize the internet for a function. Blockchain is the enabler that will be utilized in different industries for functions. Now, within those industries and sectors, there will be companies and projects that will come out of it. Again, let's go back to the internet. Amazon. I was around when Amazon started. Yes, I'm that old. I actually have videos out there where I was interviewed on TV.com before Jeff. We had a company that did e-commerce for everybody. Jeff did the bookstore. I'd say we took a battle. He won the war. But when the internet bubble collapsed in 2000, Amazon was at the brink of not making it. eBay was at the edge. Pets.com, again, I talk about this all the time. I love Bill Gross, Idea Lab. He is a man ahead of his time. How far ahead? Well, about 20 years ahead. He had a company called Pets.com. People made fun of him. It collapsed. He had Toys.com. His theory was, hey, a lot of people want to go buy things around pets. Well, it was too early. The bubble collapsed. Distribution wasn't, a lot of reasons for timing. Fast forward 20 years later, you have Chewy.com, which is probably a $4, $5, $6 billion company. Is it an original idea? No, it's stupid. It's Pets.com 20 years later with infrastructure that can be executed. Now, does that mean it's a bad idea or a stupid idea? No. Is it original or unique? Absolutely not. It's a retrench of an idea that before didn't work, but out of the ashes of the internet collapse came bigger, better, stronger companies. Now, some of that was better business models. Some of it was timing where the companies were allowed to mature. Some of it was the technology caught up with what was going on. Some of it was just people became more comfortable. I remember when I started my e-commerce company in 96, we have videos where Visa and people said, oh, we'll never shop on the internet. People will never put their credit card online. E-commerce will never work. Well, it worked. Didn't work right away. It worked over time as people became more comfortable with the technology. So where does that leave us? Again, crypto crash, crypto winter. For a lot of these crypto assets and tokens, yeah, they've collapsed. Will they come back? Probably not. There's a bunch of them that never deserved to get money in the first place. They weren't real projects. Now, maybe they were real projects in the mind of the entrepreneur who thought they were going to do something unique, but they weren't real businesses. And most people who invested in that asset didn't invest because there was a business there. There weren't fundamentals. There weren't revenue. It was, hey, here's a cool new idea that we think will be huge. Give us money and your token will go up in value. That sounds a lot like the internet days. I remember, again, going back, people would put a .com, go, oh, I'm a .com company. Sears.com, when Sears became a .com, and those of you may not remember Sears, I think it's still around. Sears isn't a .com. It was a retail company that had a website. Oh, but let's be a .com. Kind of going back a little bit, there was a tea company, I believe, who said, oh, we're going to do tea and we're on blockchain, and their valuation went up 30% because they're blockchain. It's hype. It was promotion. It's pure speculation. Most of these crypto assets were not fundamental investments. They weren't fundamental businesses. They were speculative hype for things that people bought at 10 cents because they wanted to go to $1. Most people I know don't buy cryptocurrency. It's not a currency. They don't buy a 10-cent token because they want to buy a cup of coffee. They buy it because they want it to go to $1 and make money. They don't know about fundamentals. They don't care. As you move upstream in investments, again, if we look at traditional arc of investment, you have an angel, loves the idea, gets in early. Business may or may not even be there. There may not be a website. There may not be a product, but the angel believes in the vision. Get a little bit more, Series A. And then the Series B guys come in because now there's a business and you can validate things. And if the company grows and eventually goes public, then you've got analysts who can look at what's the business and what's the revenue and what's the projections. When that company gets bigger, you've got EPS and earnings per share, and analysts predict how much you're going to make. And if you miss it by a penny, your stock goes down. All of these things are levels of validation as companies grow. Most crypto had none of that. Crypto were pure speculative crypto assets, which are penny stocks that we thought would go up in value. Now, we can fool ourselves. We can say, oh, no, I'm a utility token. Oh, I have a function in a marketplace. I don't know any that have worked. Oh, no, I have a function of a utility in a marketplace that people buy and can spend. Haven't seen one that worked. So where does this leave us? Is the crypto winter good, bad, or indifferent? In some respects, it's good. It's going to collapse the market. It's going to clean out projects that probably never deserve money. I think bigger, stronger projects will come out. Do I think crypto tokens and assets are good? Absolutely. You put money in an equity investment as an angel or an early stage investor, it might be 2, 3, 5, 10 years for you to get out of that investment, if ever. If that investment goes in on a token that at some point gets listed on an exchange and has a little volume and a little liquidity, at least you have an option to get out. Right? I think the US, anybody that's watching this, share this with the SEC. The SEC could make our life easy in crypto. Crypto is not this weird new asset. It's not this weird new commodity. It's really simple for the most part. Companies use crypto as a way to raise money and they give something back to the investor. That sounds a lot like stock or, yes, securities. I know crypto doesn't want to be securities, but we really kind of are. The U.S. has something called the Jobs Act of 2012, which allowed companies to do crowdfunding for equity. Again, if you're doing crowdfunding for equity and an investor puts $10,000 in your company for equity, they have a 90% chance of losing their money. 90% of the startups fail. If they put $10,000 in your company for equity, but it was tied to a token, a crypto asset, a digital asset, I don't even want to call it a cryptocurrency, it's a digital asset versus a stock that they own on your cap table, your capitalization table. That digital asset could at some point, if the company starts being successful, trade on an exchange and generate liquidity quicker, faster, more transparently for the investor than putting their money in equity. The Jobs Act was designed to protect the investor. Digital assets are a better investment structure for investors. And it's not just going to be early stage investors. It's going to be OTCs. It's going to be microcaps. It's going to be the stock exchange. It's going to be big companies. And again, if you guys have seen my other interviews, John Najarian from CNBC, I talk about this. People are like, oh, do you think crypto will ever be bigger than the stock market? That's an irrelevant question. There's not going to be any more cryptocurrency. It's not going to exist as a distinctive class, in my opinion. It will be a digital asset. Now, whether that digital asset is direct to the public, kind of like a direct public offering, or whether it's done through an investment banker or a company, I think everything will eventually be digital. Why? Again, I'm covering the arc. Look at some company like Apple or Amazon. The way traditional stock works is if it gets to a certain price point, if Amazon stock gets to $1,000 or $2,000 or $3,000, stocks do what's called a split. People are always like, oh, the stock's going to split. What does that mean? It goes from 3,000 and it may drop if it's 2-to-1 to 1,500 or 3-to-1, 3,000. That means the price of the stock drops to make it easier for people to buy the stock. If it gets too high, $3,000, $4,000, $5,000, $10,000, it's more difficult for somebody who says, hey, I've got $5,000. I can't buy 1.5 shares. At a $1,000 stock price, they can get 5 or 10 shares for $10,000. Stock is not divisible. A digital asset is divisible. Look at the price of Bitcoin. If Bitcoin's $20,000 or $200,000, it's irrelevant. People go, why? It's more. If all you can buy out of Bitcoin, if Bitcoin's worth $20,000 and you can only buy $2,000, you can buy fractions of a Bitcoin. You can buy it in small amounts, kind of like gold. A brick of gold's $500,000, a gold coin's 50. Bitcoin's 20,000, you want to buy $200 worth? Great. That $200 is the same $200 whether Bitcoin's 20,000 or 200,000 or 2 million. It doesn't matter. You have $200 to spend, you buy that amount of that digital asset, and that $200 goes up and down as the same percentage as the guy that can buy the whole asset. Again, what does that mean? Eventually, in my opinion, all stock will be digital assets. Then the price becomes irrelevant. If Amazon stock goes to 1,000 or 5,000 or 10 or 15 or 20 or 100, it no longer matters because digital assets are divisible. That fractionalization of an asset allows more people to buy into a company's assets. It allows more people to get liquidity. It allows that company to grow with a bigger shareholder base because more people can participate. It's also more transparent. If a company's issuing digital assets on a ledger, you can audit that. You can see it. With traditional stock, you can't. The SEC is running around trying to manage crypto like it's some bad thing. Are you kidding me? Digital assets are a better investment class. They are more transparent and more clear. Now, does that mean it's less risky? Absolutely not. But startups are risky. 90% of startups fail. Put money in a crypto asset, it may fail, but it may go up. I think coming out of crypto winter, we're going to see bigger, better, stronger projects. So is it good? Yeah, it's good. Is it bad? Sort of. For guys like us and companies and all my friends that are in the industry, we're taking a beating right now. Assets are down, values are down, raising money and capital in the space of digital and crypto. It's a challenge. But hey, raising money is always hard. Raising money in a traditional market is hard. Raising money right now at the end of, not the end of, the middle of 2022, recession, stock market's down, wars are going on, inflation's rampant, companies are pulling back. Companies are difficult. It's a struggle. Is it more of a struggle than crypto than something else? No, actually, I'd say now they're about the same. Raising capital is always hard. With crypto, it's just been super easy. Why? Because it was easy for speculators to get into the asset. What does that mean? That means there's a pent-up demand That means there's a large swath of people who would like to invest in projects. Yes, it's risky. Yes, they should understand the risk. Yes, it can go from 10 cents to $1. Yes, it could go 10 cents to zero. But that asset class, to be able to get in and get out and get in early, that appetite for the investors, for the participant, is not just US, it's global. You've got a global audience of people who are looking for returns. They're looking for things. The challenge is, how do you discern between a speculative asset and a sinister one and a scam? It gets more challenging, but I think it'll get easier. There will be more transparency. There will be more qualified projects. There will be things that come out. So is the crypto winter bad? It's bad in the sense that it's hurt momentum. It's hurt the industry credibility-wise, but not for the sensible person. The sensible investor can look and go, oh, the market's down, but so is the stock market. Things are challenging now. Things are challenging in the real world. Not that crypto is not the real world, but the markets as a whole are challenging. This is a great opportunity. I never did this in 08, 09, but many years ago, and I can't remember all of it. So again, this is sort of under oath. Don't hold me accountable. But years ago, I did a study and I had all of the reports that showed this massive collapse and recession. And I don't remember what year it was. It might have been 80s or 90s. Again, I don't recall, but it basically showed under one of these huge depths and recessions, these massive companies came out, Oracle and huge companies that were ultimately successful. I think HP, again, don't hold me to it, but the point is, in these recessions, in these times of darkness and demise, stronger, better, more successful companies come out of these depths. Not all of them recover. Some companies go away and never come back. But the ones that do come back are better. They're stronger. The industry grows and recovers. And that's what I think is going to happen with crypto winter. So is it good? Yeah, it's good. I think it'll clear out. Is it bad? It's bad in that it hurts momentum in the industry right now. Is it irrelevant? Absolutely not. Crypto, I think not only is it relevant now, it will be infinitely more relevant moving forward. If you look at crypto with the multiplicity of what it can do, crypto as a digital asset like a stable coin, crypto as a non-fungible token for you to be able to do things with assets. My next podcast will be on the different uses of NFTs and how it works. Crypto is a way to raise capital transparently with better liquidity options for the investor. Crypto is a way to fractionalize ownership, whether it's fractionalizing ownership by selling the digital asset, or whether it's fractionalizing it by the value of that asset going up and people being able to buy fractions of it by percentages. It all is going to change. Blockchain is here to stay. Crypto assets, digital assets, all of these things are here to stay. So it's not irrelevant, will never be irrelevant. Again, I don't think there'll be a distinction 3 or 4 or 5 years from now. There won't be blockchain companies. It'll just be part of the fabric of a company. You'll be a game company using blockchain to perform a function better than somebody else. You'll be a transaction company using blockchain to be more efficient. You'll be an invoicing, you'll be payment, you'll be a contracting company. Blockchain is going to enable these companies to be better, more transparent, and more efficient. And part of that blockchain may be using a digital asset to raise capital. Part of it may be using a digital asset to fractionalize. But at the end, blockchain is the great enabler. So I think we're going to come out of it bigger, better, and stronger. Will we come out faster? Wow, I still don't know, but I hope so. I have big belief in the industry, big belief in the understanding of where this can go, what the technology can do, and what crypto can do for companies, what it can do for consumers, and what it can do for investors and speculators and the retail consumer who's looking to invest in an asset that has a higher rate of return. Again, speculative, risky, absolutely, but it is an asset class that there's an appetite for if people understand it. And I think better companies, better projects, better returns will be coming soon. I just don't know how soon. I hope it's soon enough. Anyway, Steve and Meade, another Bullseye Guy podcast. Again, tune in next week. I think I'll do one on NFTs and the distinctions and the explanations. But again, be safe, stay strong, keep investing, keep participating, and we will see you soon.